Hello traders, welcome back to my channel The Stock Monger. You're watching Ali Abbas. In this video we're going to talk about how we can consistently grow the portfolio in a very safe and secure manner. How it is done, everything will be explained in this video. I must inform you, I must give a disclaimer first off that this is completely as per the risk appetite that someone can handle. It has worked for me, so I'm going to share how I do it, and this plan is for anyone and everyone. It doesn't require any mathematical calculations. It doesn't require a lot of studies in the stock market. It's just about writing options in a very secure way. Now when I say writing options, it means selling options, for those who are not familiar with the term. This is a very sure shot, slow and easy method to grow your portfolio bit by bit. Now I have seen a lot of stock market players who make big bucks, because they are experienced, they can carry the risk size, their position sizing is very high at times. So that is completely for the experience. This is only for beginners, where I am going to teach you how to get into the stock market by writing options in a very safe and secure manner. We're going to hedge a covered strategy. So I don't know exactly what this term is. I don't go into the technicalities of naming a strategy, but I'll just explain how it works and how you can make money consistently and grow your portfolio. Now this method, yes, the returns are very slow and the risk is very small, but if you are patient and build it over a period of anything between 60 to 72 months, that is 5 to 6 years, then you will see that yes, this actually works and you can consistently grow it. I am not a fan of investing in mutual funds because I don't know what's going on. I don't know where the money is going, and then there are handling charges. Every mutual fund has this different way of handling your money. They take handling charges. You cannot withdraw it all at once. It is not in your control. It is not in front of you. You get these reports, which again I don't believe. I have invested in mutual funds before. They didn't give me any satisfactory returns. When I compare it to the fixed deposit, it was absolutely the same after 7 years of investing in mutual funds. So I was quite disappointed that I just wasted 7 years based on someone's advice of getting into mutual funds. But however, looking at the way the markets are working right now, I am sure that this is working for me. So that is why I'm going to share it with you. For more information about the strategies and which strikes to take, I have my forum on the Stockmonger website, that is stockmonger.in. Please do log on, register yourselves, and follow and learn from the trades that I make. So I'll see you on the website, I'll see you on the forums. Every month we have a special forum of which stocks to take and why are we going to take that, so that is also included. So please be sure to participate as much as you can. It's an open forum where every member can post. I am looking forward to your participation. So let's get started on the strategies which I'll be deploying for July and August. And it's just a simple trading. Please do always consult your financial manager before getting into this type of trade. That being said, let's get started. So traders, here we are on my Zerodha page, and I'm going to show you the strategy which I have been using for quite some time, and it has proved to be very beneficial. It is a slow strategy for making money, but if you are consistently making profits on a weekly basis by writing options with a covered hedge, then there is nothing like it, and I'll show you the best and safest way of trading in this strategy. So let's ignore the percentage that you see over here, the 1366, the 40%. Let's just ignore that for now. So we are going to buy 3 lots of Nifty 14,000 put and 3 lots of Nifty 16,400 call. These are the two premiums that are the closest at a good distance. So why did I take 14,000 put of Nifty? Because that of August, because that is the last option available that is trading right now. So 14,000 put of August for Nifty. Now what are we going to do with the current week, that is the 23rd of June? So we have options written over here at 14,000 same level and 16,400 call same level. So I just did the basket order creation over here. If you just see it on calendar Nifty 50, you will see that I have bought 3 lots and I have shorted 6. The total requirement of capital final margin is showing as 3,16,000. Now let's look at the analysis. In the analysis over here, you can see that if the market moves one-sided, let's say it expires somewhere above 14,000. Your break evens are showing over here 13,863 and 16,595, which means that if the market on this coming expiry expires within this range, and this red dotted line you see, this is your profit. Now suppose the market is flat between this area, in this area that you see, okay, between let's say 14.7 and 15.5. If it expires within this market, we are not going to touch the hedges that we bought. So let's just move this out of the picture. And if you're only looking to book the profits on the options shorted for the current expiry, you would get a maximum profit of 2085, that is ranging from 16,400 to 13,993, and your probability of profit is 98%, which is pretty good. Now, what happens when you close these expiries, assuming again that it is within a 200 point up or down range? Okay, this is what you would do. You would close the 23rd, these two, you would close these, and then you would go for the same strike price on 16,400 and 14,000 for June ending. So let's put 14,000. This is just an example. The premiums can change, so that is again subjective. So 16,400 call and 14,000 put. You would take the same levels as you did for 16,400 and 14,000 levels, okay, but you would start with only selling 3 lots, not 6. I'll explain this a little later. Please watch the video till the end. Now look over here. If I adjust these to 3 lots and this also to 3 lots, okay, your capital requirement is 1,44,000. Why did I do this? Simple. Let's just go to the analysis chart. Okay, let's just forget these levels and these mountains over here. Okay, suppose the market is moving one-sided all of a sudden, because over the weekend there can be some news, or Tuesday gap up, gap down opening, there can be some news. Wednesday again there can be some news. So what you would do is you would add the lots on the winning side, which means let's just remove these two. Okay, so if market right now is at 15,300 approximately. So let's say it closes on Monday at 15,000. So your call side would have lost a fair amount, and you can book this profit and shift it down further, let's say by 2 to 300 points. Very doubtful that Nifty would just break out and suddenly rally for 800, 900 points in a given day. Very rare. So what you can do is you can just book this profit and move it down and leave this untouched, because this is covered by this. The put of the current expiry is covered by the buying of the same level expiry almost 8 weeks ahead. So if it goes down, the put will expand without decay, and the put of the current expiry will not expand that much because there will be some decay. It is not in the money, it is out of the money. So for it to gain a lot, it's very highly unlikely that this will shoot up beyond what you have over here. But since they are the same lot size, the advantage is in your favor. The calls that are depreciating, you can book those that you have sold and move it down at least 2 to 300 points and get the same premium. So this is like 2.5. If it comes down to 0.5, let's say for example, you've already made 300 rupees on the 3 lots that you've shorted. So now you bring it down 200 points and you add an extra lot. You add like let's say one extra lot. So you have 4 lots, that is 200 quantity, and you have a 2 premium showing at, let's say, 16,100 or 150. So that way you can adjust and pull it further, but you just have to be clear on what the levels are. If there is a 2% or 3% down move, your downside is secured. There's not a problem with that. Your call side is losing value, but then you want to make maximum gains. So you would add extra quantity over here. That is the way you adjust, and I'll be sharing these adjustments and all these in the forums of my website stockmonger.in. If you are not yet registered, please do register and follow my trades. You will learn how money can be made consistently and securely. So if I have the market finishing flat at, let's say, 15,000 or 15,200, the August puts probably will expand because it's come down by 200 points, very marginally expanding. Yes, the 16,400 call will also lose, so there will be a balance in that. Now, the puts that I have shorted on this side are again covered, and since it's a 1,000 point cushion, I have nothing to worry much about unless there is a need for adjustments. The 16,400 call option that is shorted, I have shorted again 6 lots, that is 300 quantity at the rate of 8. So let's analyze this now. So as you can see, suppose let's say, okay, you booked your profits for 23rd June expiry. Now you have taken 30th June expiry. You've taken 3 lots, and on a Monday you see that the premiums are the same. There is a little movement in Nifty 50 index, which has come down quite a bit, and the opening on Monday is 18. So what do? Do you take 6 lots? No, you do not. You stick to only 150, and you increase the lot shorted on the call side because you want this to stay between these. Now let's say that the market is keep on moving downward. Now you would not add any quantity on the downside. You will keep on booking quantity on the lower side, and the market is directional and finishes at, let's say, 14,200. Okay, 14,200. So on the expiry, as you can see, it is showing a total profit on your entire covered strangle at 20,700. What would you do? Would you book the entire profit? No, you would not. You would only book the hedges over here, and I'll tell you why. 14,200 you finished, but your safety break even is at 13,972 and 16,427, as you can see over here. So if it closes and expires, you get all this profit of 8,000 rupees. You close it. That is, yes, if you're adding quantity towards expiry, you close it and you add 14,000 put option on the July expiry, the next expiry that will be coming for July, that will be 7th of July. You add those, and you would add the calls as well, a little heavier because you want the puts to roll back. Now, there are two options that you have in front of you. One is that, okay, you book this entire profit of 20,000, what we saw in the last, okay, here at 14,200, you have 20,700, you book it completely and you shift it where you take the last strike, you buy the last strikes of August on either side, and again you follow the same method of buying the same equivalent strike, shorting the same equivalent strike for the current expiry, and you keep shifting and making money that way. You need to maintain a diary of how much profits you're booking so that in the end, if the market closes between 14,000 and 16,400 by 25th August, you would not want to take this loss of 52,000. This loss of 52,000. So you have to keep measuring how much you're making, and at the same time be very vigilant of the levels that you are taking. Surprise gap up, gap down are always covered because the quantity sizing will be the same. Here I just put 6 for an example, but if you take 3 at the quantity sizing, then you would be safely covered. So this is a strategy. If you like to know more information, and you'd like to follow me step by step, please do log on to the stockmonger.in. The link is in the description, and I'll see you there on the forums, and let's make money together.